I want to throw up this chart to take a look at the run-up that we have seen in the yuan, the Chinese currency. This is a CNH cross rate reaching the highest since July, ahead of the signing of that phase one deal. Going forward, are the drivers in terms of inflows going to be sustainable for the Chinese currency if you consider that we may not get a phase two deal this year?
Well, let's be frank. The problem is not the renminbi, so therefore the solution is not the renminbi. The renminbi is a sideshow, really, in all of this. Here, the US has an economic problem that it defines itself, where it's looking for a political solution. Now, not to bore you to tears, but in 1985, the US had a very similar problem with Japan, and you can see I've modeled my hairstyle on the 80s, my big bouffant. But anyway, they had a problem with Japan, and there they tried to solve the problem in the Plaza and Louvre Accords by changing the value of the currency. They didn't do tariffs, they didn't do deals, they tried to change the value of the dollar, and it failed. So this is the same problem the US has got with a different country, and they're looking for a different solution. So what I'm really saying, and when you say currency, guys, you know, we're a sideshow. The FX is a sideshow to all of this, because you saw yourself, they're saying, look, don't move the currency around, let's see if this deal works. So we should see some stability in renminbi. Yeah, of course it can move up or down 2% here or there, but we should see stability in the renminbi once this deal is signed.
Look, David, you could never bore us with your opinions nor your hairstyle, so don't worry about that. But give me your views on the dollar then, because that's why we get you on. I think last time we spoke, you said the dollar is like a bad hotel. What about 2020?
Well, it's still, I mean, the reason I've said the dollar's a bad hotel, because you don't like it, there's lots wrong with it, and you always pack your bags, get ready to leave. But when you walk outside, there's just garbage everywhere. So you check back in the hotel. So you tell me where there isn't garbage, where we're going to go. You just showed a chart here of Aussie 10-year yields at 117. I get paid less for buying Australia than I do for buying the mighty dollar. Why would I do that? So foreign ownership, for example, of Australian bonds has plummeted. So this is the problem. You got to, if you want to make me buy some market that's not the reserve currency of the world, not the most liquid instrument in the world, and you're going to pay me less for it, why would I buy that? So the dollar still retains, you know, its status as the high yielder with the most liquidity and the safest. So it's beautiful. I mean, I don't know. Everyone's telling me the dollar's going down. I just can't see it.
So, okay, so if you're seeing the dollar gaining ground, what does this mean also for the gold? Is there a possibility that that inverse correlation could break if we see more financial strains in 2020?
Yeah, well, it's breaking already. I mean, you know, everyone's doing the old barbell strategy, you know, with a big weight on the one side, a big weight on the other. So on the one side, you're buying risk and you go, yeah, let's go for it, let's go for it. On the other side, you're saying, well, what if everything goes wrong? Let me own gold. So this seems to be the strategy that we're seeing in the market. You can still see people buying risk, people buying, like the Rand doing quite well, which it shouldn't in our eyes. You've seen Turkey stabilize. You've seen these high yielders. So that means people must be buying them. But on the other side, they're saying, oh, let's buy gold. It could go horribly wrong. So it seems to me the market's playing this kind of barbell strategy. But yes, I think you could see a stronger dollar with higher gold prices. Absolutely.
How much of this would be helped by the U.S.-China trade deal? Because Secretary Mnuchin now coming out and saying, you know what, we're going to see economic growth here in the U.S. of around 50 to 75 basis points more because of the trade deals.
Who's saying that? I haven't seen anyone changing their forecast.
Treasury Secretary Mnuchin saying that. Yeah, we're not quite sure where he's getting the numbers from, but that's what he's saying.
There's a difference between actually having to forecast it and being a political representative of a country. So I haven't seen anyone changing their forecast. Everyone has slower growth in United States, Eurozone, UK, China. I could go on. Everyone's got slower growth in 2020 than 2019, with a few exceptions. But the big boys all have slower growth going into 2020. That's the consensus among forecasters that have to forecast economy, not politicians that have to forecast politics.
All right, well, we're going to get more politics, right? But are you saying when it comes to sterling, the influence of politics is going to be less influential this year? Are we actually going to see cyclical factors, particularly as we see the GDP numbers, the inflation numbers? Is Mark Carney going to leave with a swan song of easing this month?
Well, it's still very possible that he could cut rates, and our economists are looking for a rate cut, so that's very possible. But the political risk has diminished. The political risk was very negative for sterling. So we've taken one negative factor and we've chucked it away. That's got to be good for the currency. The one currency we are very bullish against the dollar is sterling. We think that the political risk has gone down. We're starting to look cyclically and compared. So you say, yeah, the numbers are poor, etc. But did you see the numbers from Europe the other day? Did you see those German GDP numbers? Did you see those industrial production numbers? They are awful, and they've been awful for 15 months. There's no sign of a pickup in Europe. So why shouldn't sterling do well? And the beautiful thing about sterling, it's nice and cheap. So it's cheap and it's good. So when you're looking for that alternative to move out of that bad hotel, there's one across the road. It's called sterling, and we think it's great.
David, what about this part of the world? How do you feel about the mighty Aussie, if you will?
Well, you just showed me a chart of Australian yields at 117. I mean, why would I buy something in Australia with Australian dollar risk, with it being a much smaller, less liquid currency and earning less than my bonds in the United States? Why would I do that? And so we've seen foreign ownership of Australian bonds fall. Yes, of course, the local pension funds have to buy, etc. But that's not a currency. So the currency's fallen a long way, and we don't expect it to recover very much. Tom Nash, our economist and currency strategist in Australia, has had a brilliant call. He called it down to 68, and we think it can just hang around there. We're not looking for any great recovery in Aussie. And Kiwi, a very similar story. You've got yields less than the United States. Why do you want to buy them? And foreign ownership of their bond market has fallen. And this is what's happening everywhere. If you start offering me less than the mighty dollar offers me, your currency is going down. So I don't know why everyone's got this weaker dollar. Everyone's like convinced themselves the dollar's going to be weakened. It's the third year in a row they're going to fail. They got egg on their face last year. They got egg on their face the year before. And now they're going for the triple egg.